Hey everybody, welcome back to Shine's Room. Today we are here again with Jim Riggio, the options master himself, and we're going to go through some of the interesting parts of options that most people don't know about. Once again, it's called the Greeks. So just to hand it over to Jim, I want him to give a basic background of some of the Greeks and how to use them or implement them in the marketplace while trading options. So take it over, Jim.
Thank you. As a quick primer, I just wanted to be able to go over some of the different Greeks. There are basically 5 of them, okay? The first one, and probably most important to options traders when they start, is delta. What delta basically is, in its simplest form for you to end up thinking about, is that if you own an options position, or if you're long a put or short a call, whatever, it'll end up telling you basically how many shares of stock it's equivalent to. Like, so for example, if I own, we talked about IBM last time, if I own a call at the money, it's trading at 175, I own the 175 call, I'll probably, that call, while it gives me the right to buy 100 shares, it'll only move at about half that rate. So if IBM goes from 175 to 176, that call's probably going to go up only 50 cents. So I would have, if that's, and that's the definition of it, by the way, how much will I make or lose if the stock price moves $1? So if I have a delta of 50, and most of your live trading systems will show you this, if I have a delta of 50, and it says that if the stock goes up $1, I'll make 50 cents. Basically, that's delta. There's a lot of things that go into it mathematically, but that's the simplest way. What ends up happening is that if it goes up a second dollar, so we go from 175 to 177, while I make 50 cents on that first one, I'll probably make maybe, say, 52 cents if it moves up another dollar. So what happens is that deltas change, okay, as the price, the time left to expiration, or the volatility that we talked about, that implied volatility, that cost of insurance, as those things change, okay, especially as the price changes, what will happen is that you'll end up making more money on a long call, depending on your position. How much that delta changes in the second dollar, that's what gamma is. So basically, you know, for you guys to know a little bit more, gamma is considered to be the change in the rate of delta. Don't let the math end up getting to you. What I end up always thinking about, I'll make $1, okay, I'll make 50 cents if it moves $1, I'll make 52 cents if it moves a second dollar, the gamma is 2 cents. What happens if, remember I talked about why I love to sell those puts when the market's dropping? It's because that the price that people are willing to end up paying starts to go up. Well, what ends up happening is that's measured in volatility, or implied volatility. So what happens when that price goes up? How much will my 75, okay, if the implied volatility, let's say, goes from 25 to 26, if it goes up 1 volatility point, how much money am I going to end up making in my long put? That change in how much money I'm going to make if volatility goes up 1 percentage point, that's what Vega is called. Okay, again, not to get crazy about it, the important thing to realize that if you have a long Vega position, you're only long Vega if you're long options. If I'm long a put or I'm long a call and volatility goes up, I'm going to make money. The opposite is also true. If I am short an option, if I'm short a put or a call, okay, I'm going to be short Vega, I'm going to end up losing money if volatility goes up. Okay, so that's the basics of it. What ends up happening, and the only one that's constant, is, you know, we talked a little bit, okay, last time about renting a position. I like to think of it that way because what theta is if the option stays here and nothing changes, price doesn't change, implied volatility doesn't change, how much am I going to make in a day, or how much am I going to lose? This is also pretty consistent, where if I own options, I'm renting them, so I'm going to have to pay that rent every single. How much do I end up having to pay for rent for that options position in a day? That's what theta is. By the same thing is, if you sold the 175 put in IBM like we talked about the first time, I'm going to be collecting money every single day. How much do I collect, okay, for selling that? Again, if price doesn't move, if volatility doesn't move, that's how much I'm going to collect in theta. There is a fifth, okay, Greek, but we almost never talk about it, and it's what happens if interest rates change. I guess if interest rates weren't at 0, it'd be kind of important, but with 0, it really doesn't make a difference. But we call that rho. And those are your 5 Greeks, and thank you for listening.